What if you had like a secret blueprint, a way to understand one of the most successful minds in history,
Yeah, we're talking about someone whose investing career, well, it spans nearly 6 decades.
and he outperformed the market by just a staggering margin, turned a small textile company into this global conglomerate?
Absolutely. So today, we're taking a deep dive into the Warren Buffett way. We're drawing insights from a really comprehensive look at his philosophy.
And our mission really is to pull out the most important nuggets of knowledge, maybe some surprising facts about how he actually thinks, how he operates.
Exactly. And as you'll find, it's profoundly about decision making, about rationality, maybe even understanding yourself better
Hmm.
in, this world filled with financial noise.
It really is. This isn't just investing tips. It's more like a master class in rational thought, wouldn't you say?
I would, yeah.
So get ready. We're going to unpack the core principles that let Warren Buffett become, well, the world's greatest investor, and maybe figure out what they mean for you.
Mm.
So to really get the Warren Buffett way, we have to go back, way back, not just his first stock pick, but to his early life, where that drive really started.
It's pretty amazing how early it showed up.
Right. What was it about his childhood that kind of set the stage?
Well, the sources, they really point to the Great Depression. It made this huge impression on young Warren, apparently gave him an absolute drive to become very, very, very rich before he was even 5.
Wow, before 5.
Yeah, that early experience with, seeing financial hardship, it clearly forged this lifelong determination.
That makes total sense. And from there, his childhood fascination with the stock market just, well, it exploded, didn't it?
Oh, completely. Spending Saturday mornings hanging out at brokerage offices,
Yeah.
just soaking it all up.
Yeah, and he had those two great uncles, right? Frank, the pessimist, the bear.
Right, the perpetual bear. And then John, the maternal great uncle, the optimist, the bull.
Always the bull. And they're both telling him stories, pulling him in different directions. Meanwhile, he's reading Barron's, charting stocks, devouring every investment book he can find.
Just trying to make sense of it all. And all that self-study, that eventually led him to Benjamin Graham.
Graham, the big influence.
Huge. For Buffett, Graham gave him the first reliable map for the stock market, changed it from, like you said, this pseudoscience similar to gambling into something with a real methodological basis, foundational stuff.
And didn't he get like the only A+ Graham ever gave out at Columbia? Or something like that?
That's the story, yeah. The first A+ in 22 years of Graham teaching there, which says a lot.
It really does. So what were Graham's core ideas then? Safety first.
Pretty much.
Yeah.
He had these core conditions, a degree of safety of principle, number one, and then a satisfactory rate of return, even if it was low. But he always added that caveat, right? Safety is not absolute,
Right, nothing's guaranteed.
which led straight to his critical concept, the margin of safety.
Okay, margin of safety. Explain that. It sounds important.
It's absolutely crucial. Think of it like building a bridge.
Hmm.
You design it to hold 10,000 pounds, even though you only expect 5,000-pound trucks.
So a buffer.
Exactly, a huge buffer. In investing, it means buying a stock at a price significantly below its true worth, its intrinsic value. So you're protected if things go wrong or the market tanks.
So you buy when things are cheap, like in a bear market.
Either the whole market is low, yeah, like a bear market, or just a specific stock is trading way below its intrinsic value, even if the market's doing okay.
Okay, but intrinsic value, that sounds fuzzy. How did Graham make that concrete? How do you calculate it?
Well, he defined it as that value which is determined by the facts. He focused on future earnings power, mainly. Multiply that by an appropriate capitalization factor.
Determined by the facts. Okay.
And he just fundamentally believed the market frequently mispriced stocks. Why? Human emotions, fear and greed. But eventually, he thought, prices revert to the mean. They catch up to the true value.
So Graham provided the quantitative foundation, the map. But then there was Phil Fisher, another key influence, but different, right? More qualitative.
Yeah, very different. Fisher pushed his thinking in a maybe a counterintuitive direction for a strict Graham follower.
And there's that funny story about Fisher's son confusing Warren with his own father.
Right, yeah. Fisher's son initially mixed up Warren Buffett with Howard Buffett, Warren's dad. Just shows how synonymous Buffett from Omaha became even then.
Right. So what was Fisher's philosophy? What did he add?
Fisher believes superior profits didn't come from buying cheap stocks necessarily,
Yeah.
but from investing in companies with above average potential and, crucially, most capable management. He was looking for quality.
Quality over just cheapness.
Yeah.
And he had that method,
Partnering.
scuttlebutt.
Scuttlebutt. Yeah, that was his term, his business grapevine approach. It meant going beyond the financial reports.
So,
Actually talking to people familiar with the company,
yeah.
suppliers, customers, even competitors sometimes. Digging deep to get the qualitative feel, the stuff not on the balance sheet.
Getting the real inside story.
Exactly. And that naturally led him to prefer concentrated portfolios. He'd rather own shares in a few outstanding companies than in a larger number of average businesses. Deep research on a few bets.
So, Graham, numbers, safety, price, Fisher, quality, management, deep understanding. How did Buffett weave those together? This seems like the core of his evolution.
It is, and the pivot point, the famous example, is See's Candies in 1972.
Ah, yes, C's, where he seemed to break all the Graham rules, paid 3 times book value. That sounds crazy for a value guy.
It was totally shocking by Graham's standards. He paid $25 million for See's, 3 times book, even though it had $10 million in cash just sitting there. Graham would run screaming. It wasn't a statistical bargain at all.
So what changed? Or who changed him?
Charlie Munger. It was Charlie Munger who was crucial here. He convinced Buffett to pay for quality.
Munger again. Okay.
This was really the first major move away from Graham's philosophy of only buying super cheap bargain basement stuff. Munger helped him see that a fantastic business, even if it cost more up front, could generate way more value over the long haul.
And did it work out?
Did it ever? 10 years later, Buffett was offered $125 million for See's. Paid $25 million, offered $125 million. Yeah, Munger was right.
Wow. Okay. So it wasn't ditching Graham entirely, but building on him.
Evolving.
Precisely. It became this powerful dovetail, as the source calls it, combining Fisher's feel for the business and management, the qualitative, with Graham's grasp of price and value, the quantitative.
So he moved away from Graham's method of only buying cheap.
Steadfastly away from the strict methodology, yes. But he kept the theory of margin of safety. He just applied it differently. Now it's about finding great businesses at a fair price, not just fair businesses at a great price. That's a great distinction. Which brings us right to the core tenets of the Warren Buffett way. We've seen the influences, the evolution. Now, how does he actually do it? What are the rules he lives by? Let's start with his business tenets.
Okay.
He always talks about investing in businesses that are simple and understandable. What does that really mean in practice?
It means he invests only in what he truly comprehends. Like, he owned a newspaper, the Omaha Sun, before he ever bought Washington Post shares.
Ah, so he knew the economics inside out.
Exactly. That direct experience gave him the understanding he needed to judge its value, its prospects. If he can't get his head around it, he just passes. No tech for years, famously.
Makes sense. And beyond simple, he looks for a consistent operating history and favorable long-term prospects. How does he find that predictability?
Well, that's where his idea of franchises versus commodity businesses comes in. It's a key distinction for him.
Franchises versus commodities. Okay.
Franchises are the gold standard. They provide a product or service that's needed or desired. There's no close substitute. They aren't usually heavily regulated. And critically, they have pricing flexibility.
They can raise prices without losing customers.
Right. They have that economic moat, maybe with piranhas and crocodiles, as he colorfully put it, keeping competitors out. It's a structural advantage that leads to that consistent history.
Piranhas and crocodiles. Love it. So the moat protects the long-term prospects and commodity businesses, the ones he avoids.
Yeah, those are businesses where the only real difference is price. Think airlines, maybe basic materials. If your competitor sells below cost, you're kind of doomed. There's no moat, just a constant battle. He's not interested in that race to the bottom.
Got it. Okay, let's shift to management tenets. His number one is rationality. Sounds obvious, but what's his specific angle?
For Buffett, the single most important thing management does is allocation of the company's capital, how they spend or reinvest the company's money. That, he says, determines shareholder value.
So rational managers are smart capital allocators.
Exactly. He wants managers who behave and think like an owner, prioritizing long-term value for the shareholders, not just, building a bigger empire or chasing short-term fads.
And then there's candor with shareholders. Being honest, especially when things are tough.
Yep. How managers talk or don't talk when times are bad says everything about their integrity. Fisher emphasized this too, and Buffett took it to heart. Transparency, admitting mistakes, builds trust. It's rare, but essential.
It seems rare. And the third management tenet is really interesting, resisting the institutional imperative. What's that about? He called it his most surprising discovery.
Yeah, it's Fascinating. He described it as the lemming-like tendency of corporate managers to imitate the behavior of others, no matter how silly or irrational.
Following the herd, even off a cliff.
Pretty much. He thinks it's driven by basic human nature. Nobody wants to look foolish by being different, and fundamental change is hard. So you get this mindless imitation of what other companies are doing, even if it makes no sense for your company.
That explains a lot of corporate behavior, actually. Okay, financial tenets. Beyond the obvious, what does he focus on?
First big one, focus on return on equity, ROE, not earnings per share, EPS.
Why ROE over EPS? EPS is everywhere.
Because EPS can be really misleading. A company's capital base naturally grows over time, which can automatically push EPS up, even if the underlying profitability isn't improving that much. ROE is a truer measure because it shows how effectively management is using the shareholders' money, factoring in that growing capital base.
Okay, that's a key difference. What else?
He calculates owner earnings, which is basically trying to figure out the true cash flow the business generates for its owners after all necessary expenses and reinvestments. It's about the real cash, not just accounting profits.
Owner earnings. Got it.
He also looks for companies with consistently high profit margins. Shows they're efficient, they control costs, and then there's the $1 rule.
The $1 rule. Tell me more.
It's a simple but powerful test. For every dollar of earnings that a company decides to keep and reinvest in the business, instead of paying out as dividends,
Yeah.
does it create at least one additional dollar in long-term market value for its shareholders? If it doesn't, then management isn't allocating that retained capital very well. Maybe they should have just paid it out.
So it's a direct test of that rational capital allocation idea.
Exactly. Are they creating more value than they're keeping?
These tenets really provide a clear framework. Let's see them in action. Maybe look at a few key case studies. We can't cover them all, but maybe start with the Washington Post back in the 70s.
Yeah, perfect example. Katharine Graham was running it. She drastically cut debt down 70% in just 5 years, and she oversaw the repurchase of a huge chunk of shares, like 43%.
Wow, 43%.
Unbelievable, right? Clear demonstration of rationality buying back your own stock when it's cheap, and candor in how she managed and communicated. Textbook Buffett management.
Okay, what about Geico? Also in the 70s, that seemed like a turnaround, which he usually avoids.
It looked like a turnaround exception, yeah. Geico was teetering on bankruptcy, but Buffett looked past the immediate crisis.
And saw.
He saw its fundamental franchise, that low-cost, direct-to-consumer insurance model, was still intact.
Yeah.
It wasn't a dying business model. It was like a great business that had hit a really rough patch.
A temporary problem.
Right. And crucially, the new CEO, John Byrne, was brutally honest about the problems. His Operation Bootstrap plan showed the candor Buffett requires. It proved the underlying business was strong, just needed fixing.
So the core business model was sound. Okay, then Coca-Cola in the 80s, that was different, right? He paid a premium, not a bargain bin stock at all.
Definitely not a grand bargain. He bought Coke shares in '88 at like 15 times earnings, 12 times cash flow. Pretty high multiples back then.
So why? What fit his tenets there?
Management, specifically CEO Roberto Goizueta. Goizueta was laser-focused on the super profitable core business, the syrup, and leveraging Coke's massive economic goodwill, its brand power. For Buffett, price tells you nothing about value. The value was in that incredible global brand, the moat, and the predictable earnings power, which he thought justified the higher price.
The moat, again. Okay, fast forward to IBM in 2011, a tech company. That seemed like a huge surprise.
It did surprise a lot of people, given his usual aversion to tech he didn't understand. But the rationale fit his framework.
How so?
Well, IBM, post-turnaround under Gerstner and Paul Mazzano, had shifted. It was much more focused on high-margin software and services. That made its business more predictable, more understandable, even for Buffett.
Less about hardware, more about sticky services.
Exactly. Plus, IBM was aggressively buying back its own stock. That's rational capital allocation. Buffett even said he liked it when the stock price was lagging because it meant IBM could repurchase even more shares, increasing Berkshire's eventual stake in the earnings without him spending another dime.
So he preferred it underperforming the short term. That's classic Buffett logic.
Totally. It was all about management's rationality and the predictable long-term earnings stream.
These examples really highlight how the principles apply across different industries and situations. Okay, let's shift gears a bit. Let's talk about the mindset behind it all, starting with focus investing. He and Munger aren't big fans of diversification, are they?
No, they really reject the standard advice. They argue that portfolio concentration may well decrease risk.
Decrease risk. How does that work? Seems counterintuitive.
Their logic is that concentration forces you to increase the intensity with which an investor thinks about a business. If you only own a few things, you'd better know them inside and out. Munger's poker analogy fits perfectly here.
What's the analogy?
He says, you have to bet heavily when you've got huge odds in your favor.
Well,
You don't make tiny bets on lots of hands. You wait for a great hand with great odds, and then you bet big. Deep knowledge on a few great opportunities reduces risk more than superficial knowledge of many average ones.
makes sense when you put it like that. But betting big like that requires serious emotional control, right? Markets get crazy.
Oh, absolutely critical. You have to consciously train yourself not to panic or act rashly in response to the vagaries of the market. It takes real discipline.
Munger's racetrack analogy comes to mind again.
Yeah, waiting until the good horse comes to the post with inviting odds. You don't bet every race. You wait patiently for the high probability, well-understood bet.
Patience and discipline. And understanding the market's true nature seems key, too. Buffett says prices are often nonsensical. How does accepting that help?
It frees you. If you know market prices are often driven by short-term emotion, by that voting machine mentality Graham talked about.
Right, voting versus weighing.
Exactly.
Yeah.
In the short run, the market is a voting machine, but in the long run, it is a weighing machine. If you understand the weighing part, the true intrinsic value, you're freed from the short-sightedness of relying on the daily voting. The noise becomes irrelevant.
You can just ignore the daily swings if you know the real worth.
Pretty much. Which leads right into the psychology of investing. This stuff is fascinating. There's this term, disrationalia.
It's rationalia. What's that? Sounds serious.
It's from Keith Stanovich. It describes the inability to think and behave rationally despite high intelligence. Basically, smart people doing dumb things, especially with money.
Happens all the time, right?
All the time. Human behavior in investing is just erratic, often contradictory, and occasionally goofy, as the source puts it. And people are often unaware of their bad decisions. Disrationalia helps explain why. It's not about lack of intelligence. It's about the failure to apply it rationally.
So what kind of biases fall under this? What trips smart people up?
Well, there's the classic overconfidence or overreaction bias. People latch onto recent news, extrapolate it way too far, and make these abrupt, ill-considered overreactions, especially to bad news.
Selling low in a panic.
Exactly.
Yeah.
Then there's loss aversion. This is huge. Investors feel the pain of a loss about twice as strongly as the pleasure of an equivalent gain.
Twice as bad. Wow.
Yeah. So what happens? They hold on to losing stocks way too long, hoping they'll come back, just to avoid booking the loss. And they might sell winners too early, being unduly conservative, because they fear giving back the gain more than they desire further upside.
That rings true. What about mental accounting?
Ah, Richard Thaler's idea. It's how people mentally label money. They put funds into different accounts in their heads, house money, vacation fund, this stock's money. And that affects decisions irrationally.
How so?
It connects to myopic loss aversion. You focus on the short-term gains and losses within each mental account. So you might refuse to sell a losing stock to reinvest in a better opportunity because selling crystallizes the loss in that mental account, even if it's the rational overall move.
Keeping things separate in your head leads to bad overall choices. Buffett, though, seems immune to all this.
He really seems to have mastered it. He's conquered myopic loss aversion. He doesn't need a stock price to tell me what I already know about value. It's like Ben Graham advised. You'd probably be better off if his stocks had no market quotation at all.
Just remove the temptation to react irrationally.
Exactly. Spare yourself the noise and the emotional triggers.
His whole approach really flies in the face of a lot of modern financial theory, doesn't it? Like modern portfolio theory.
Oh, completely.
Yeah.
He thinks those theories, like MPT, are designed to protect investors who have limited knowledge. Which is fine, he says, but it only teaches them how to do average.
Average isn't his goal.
Not even close. He believes exceptional returns require a different path, one based on deep understanding and rationality, not just diversification and statistical correlations.
It all circles back to the long term, doesn't it? That seems to be the antidote to these psychological traps.
It really is. There's research like from Schleifer and Vishny on long horizon arbitrage, basically making bets that take a long time to pay off.
And what did they find?
They found that while it's more expensive, in a way your capital is tied up longer, the outcome feels more uncertain. It has to generate greater returns on average. Why? Because fewer people are willing or able to do it. Patience gets rewarded because it's scarce.
So the edge comes from having that long-term perspective others lack and looking for, what was it, slow-moving ideas.
Yeah. Opportunities that require reflection, judgment, and special expertise. Ideas that travel slowly, not the obvious stuff that everyone sees and gets priced in immediately.
And this links to Daniel Kahneman's System 1 and System 2 thinking, right?
Absolutely. System one is fast, intuitive, automatic. That's a lot of Wall Street decision-making, driving those quick reactions and biases. System two is slow, deliberate, effortful, concentrated, patient. That's the mode required for the Warren Buffett way. You have to engage system two. Slow down and think deeply.
Slow down, think deeply, that seems to capture it. Which brings us to the overall Buffett advantage. It's clearly not just the numbers, though the record is just staggering.
It really is unparalleled. From 65 to 2012, Berkshire's book value grew, what, 19.7% compounded annually,
Yeah.
compared to 9.4% for the S&P 500.
Yeah.
That's almost unbelievable consistency over nearly half a century.
Extra 10% per year, every year, for decades. But if it's not just a high IQ, what is the core advantage?
He boils it down himself. First, it's behavioral. He insists, successful investing does not require having a high IQ. What it requires is temperament,
Temperament meaning?
meaning rationality,
Right.
emotional control, not getting in your own way. That's his mantra.
Okay, so temperament is key. What else?
Then there's the analytical advantage. He sees a business, not just a ticker symbol and a price. He thinks investors and business people should approach things the same way. Focus on the underlying economics. How much cash can be generated from the business long term? Forget the daily stock price chatter.
So the stock market itself, its role is pretty minimal for him.
Very limited. He famously said, "It is not a preceptor. It exists merely to assist you with the mechanics of buying or selling shares of stock. It's a tool, not a guide. If you understand the business, you can basically turn off the market."
Turn off the market. I like that. And finally, his goal of turnover reduction. What's the significance there?
It sums up so much. It's about avoiding the human cost, as he puts it, of constantly disrupting good businesses and good management teams. If you find a gem, why trade it?
Let it compound.
Exactly. Let the great business and great managers do their work over the long term, minimizes taxes, minimizes transaction costs, and lets management focus on running a business, not constantly reacting to short-term market whims. It's the ultimate long-game strategy.
Okay, well, we have really taken a deep dive today into the essence of the Warren Buffett way. And it's clear his success isn't just numbers, it's this unique blend, isn't it? Deep business insight, that unwavering rationality, and just a profound long-term mindset.
Yeah, it's about seeing the real value, having the conviction to act when you see it, and crucially, having the temperament to just ignore all the noise and let compounding work its magic.
And these ideas, patience, deep research, understanding psychology, they really go way beyond just stocks, don't they?
Oh, absolutely. They apply to how you approach problems, decisions, opportunities in almost any part of your life. It's a way of thinking.
So here's a final thought for you listening. What's one area in your own life where maybe you're making those quick, intuitive System 1 decisions? And how could adopting a more patient, analytical, Buffett-like System 2 approach unlock maybe a truly significant, lasting outcome for you? Something to chew on.